Welcome to the Chesalbridge Capital Quarterly Market and Economic Overview Call. I'm your host, Eric Jefferson. A lot to talk about in this episode. Before we start, though, a few quick words from our legal team. With that, we can go ahead and begin. As we do each quarter, publish our commentary. This goes through, shares our views both on the current landscape for the global and U.S. economy, as well for capital markets. And something we started doing aligns with the old Wayne Gretzky analogy of skate to where the puck is going. What we did was identify what we would argue to be the 15 key themes likely to impact both the economy and markets for the balance of the year and look at the direction or trend. As we often talk about, markets don't trade on whether conditions are good or bad, but rather, are they getting better or worse? And the thought process as we then back into what is the macro sort of end result of these various trends that aligns us to then position portfolios where we believe there to be opportunity. Now, I painfully won't go through each one of these. Want to highlight just a few of the key areas that we're watching most closely as it aligns with our overall views and expectations for capital markets on the balance of the year. First and foremost, something we talk a lot about, growth measured by gross domestic product. That is the measure of the size of an economy. U.S. continues to be chugging along. Resiliency is a theme, a word that we've talked about for the last 18 to 24 months. Again, last year, U.S. finished well above the long-term averages. All indications suggest growth likely to continue, albeit though maybe at a more moderate pace in line with those longer term averages. Where that's important, one, if the economy is still growing, consumers then confident, they're still willing to go out and spend money. Additionally, growth ties into the underlying earnings that companies generate. Earnings, what we would argue to be the number one driver of stock prices long term. So all in all, still somewhat of a tailwind from a macro growth perspective. That is a good sign. That being said, may not be as much of a tailwind as we get a little further into the current economic cycle relative to what it was last year. Now, some of that positive momentum, a function of continued progress on inflation. As we peel back the different layers, core inflation, that excludes the more volatile food and energy, that has continued on its downward descent. Unfortunately, we have seen a uptick in energy prices, particularly over the last few months. That in turn has negated some of that overall progress. CPI as a whole has been flat for the last quarter and a half, 2 quarters. That in turn caused many to push back expectations for interest rate cuts. Those obviously being a tailwind for both the economy and for markets, stocks, and bonds alike. Despite that, though, as we'll talk in a moment, stocks continue to have a very, very strong rally in the first quarter. Unemployment, again, remains well below the long-term averages and goals. There is a argument to be made. A lot of the recent jobs have either been sponsored by the government in the private sector or government jobs themselves. One question is, how sustainable is that long term? We're going to talk about fiscal policy in a little bit. That being said, though, unlikely to see any meaningful changes with respect to government jobs, at least between now and election day. That in many ways suggests we will have more runway to go here in the quarters ahead. Consumer strength, obviously very tied to employment. One trend, we have seen some of the lower income consumers have to begin to tap credit. That's a function of having depleted some of their excess savings that may have been built up during the pandemic. That's obviously one area, not sustainable long term. Have seen a slight uptick in defaults there. Again, the key challenge when we think about consumer strength, particularly for some of the lower income earners, although wages do tend to adjust to inflation over time, that adjustment often lags. As well, the impact of inflation has already occurred. So food prices go higher. People need to spend more to purchase the same amount. Over time, their wages may increase with the price increases going forward. But again, that has a lagged effect where people feel the impact of inflation, regardless of your socioeconomic tax bracket. Sentiment overall, as we can imagine, economy is still growing, inflation moderating, people are still working. Overall, sentiment still remains very favorable. That is a key aspect. 70% of the US economy is a function of the consumer. Important that consumers are still willing to go out and spend, which in turn keeps some of that positive momentum going. As we shift gears, think about stocks. One of the best first quarter starts to a year in some time. We saw 10% appreciation for the S&P 500. That eclipsed a mark of 5,200 as well. In doing so, registered 22 new all-time highs. That in many ways was driven by a more broader, diverse market. All else being equal, that is a good sign when we see or when we compare to last year, where vast majority of gains were attributed to just seven stocks dubbed the Magnificent Seven. Those obviously heavily concentrated in the mega cap tech world that benefited from enthusiasm around AI. When we think about the stock market as a whole, S&P 500 represents 500 of the largest companies in the U.S. Growth there remains encouraging. We had, following a year of very low expectations, companies come in right in line with averages. The reason we have a slightly negative forecast or trend here going from favorable back to average is as we look to 2024, the hurdle or the bar for earnings growth has continued to creep up exponentially. So there's some very lofty goals the market is expecting companies will register. Obviously, anytime you set the bar higher, that in turn makes it marginally harder to increase. We also think about the overall macro environment. Profit margins, those directly tie into earnings. Those are still well above long-term averages, have trended down as of late. Revenue growth, that, as I mentioned, tied very closely to GDP. Still positive, but likely trending back towards average. Not as much of a tailwind there. We also think about valuations, the price of a stock relative to the earnings that it generates. Valuations certainly above average. That is not construed necessarily as a good aspect or quality from an investor standpoint. All else being equal, that suggests stocks are more expensive relative to the earnings that they generate versus historical levels. Now, that does suggest investors are confident, are willing to pay a little more in anticipation that earnings will still continue to grow. Again, not by itself a bad indicator, but one that does put that much more pressure on companies to deliver against these lofty results in what arguably will be a slightly more challenging environment going forward. One of those other key challenges is the impact of interest rates. As we talked about, given the overall strength both in the economy and the labor market, expectations for Federal Reserve rate cuts that at the beginning of this year were expected to be a total of 7 beginning in March. Those expectations have continually been pushed further and further back. Now the market is pricing in less than 3 cuts, and the argument being whether they begin now in July or September. When we think about the bond investing universe, bond prices trade on one of 2 key characteristics, duration or interest rate sensitivity being the first, a credit component being the second. When we think about credit spreads, that is a measure of what the market is telling us the risk of default is for some of these names. Those spreads continue to remain at near historic lows. Again, mixed signals included in that occurrence. On the one hand, investors are very confident Recession is not on the horizon. Generally, if it was, you would see those spreads widen. Conversely, though, the market is pricing in a lot of really good news. Good news requires companies to continue to deliver against expectations, suggesting that if they did not, a sharp reversal could be in store. Now, lastly, as we go through the geopolitical landscape, a few different areas I want to touch on. First, when you think about fiscal policy in the US, we continue to spend more than our government takes in via tax receipts. Unfortunately, that is something historically we've issued more debt. We're able to then grow out of it. That challenge or that scenario slightly more difficult when interest rates are no longer, in essence, at 0%. We pay a increasingly large portion of our GDP to simply service the existing debt. That is something I'd argue long term does force our or will force our politicians to make some difficult choices. Realistically, though, don't anticipate those occurring between now and election day. Likely that will be something waiting for whomever occupies the White House come January of next year. On the military front, obviously, we have seen a handful of escalating military conflicts. Although the U.S. role has not been active, we have felt the impact of those in global supply chains as well as in the commodities market. That is one of the catalysts that has driven oil and energy prices higher. That in turn is what has in many ways stalled some of the progress on tackling inflation. When we think about US international relations, specifically that refers to China, good to see leaders from both countries continuing to maintain active dialogue, talking about ways to work together. Obviously, two of the biggest economies in the world, maintaining those open relationships, all else being equal, a good sign, certainly when we consider all of the other volatility taking place across the globe. Lastly, do just want to highlight the election year. Historically, the start that we've had for the S&P 500, somewhat atypical. Often election years come with elevated volatility. That is typically attributed to the unknowns that a certain candidate or certain set of priorities that may be emphasized in the future. Again, the fact that the S&P had a double-digit return to start the year, part of that may be comfort that the challenger has held the office. Their policies are fairly well known. That being said, it does seem a little bit stretched in that you have two very different policy implications depending upon which of the two primary candidates would hold the office. Given those vast quantities of unknowns, something wouldn't be surprised if between now and when the election took place, if we had a uptick in volatility. That being said, markets at the end of the day are certainly more comfortable when they have a better sense of what that road ahead would entail. That's something that may help dampen some of the volatility here, but again, something we will certainly have to monitor very closely. That's all for today. Again, appreciate you taking the time to join us. Hope this was helpful. If you do have any questions, please don't ever hesitate to reach out. Thanks again.